what would be my ideal portfolio if I want to make 20% per year, 25% per year? This is what we are going to talk about today, because some of you asked for this question. What are your favorite picks if you only had a few, if you had to build your portfolio from scratch, regardless of valuations? What are your favorite business models, your dream portfolio? After all, we all have a dream portfolio, right? So what would be my dream portfolio, my ideal portfolio if I wanted to make 20% per year, 25% per year? This is what we're going to talk about. We'll talk about specific picks, specific metrics, fundamentals, and also philosophy of an investor. This is pretty important. This is the way I am investing right now and how I will continue to invest in the future. In case this is your first video from this channel, welcome. My name is Christophe Noor, and I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So the goal after all is to make 20% per year, is to make 25% per year, because I want to continue doing this. And if I continue for a few years, it will be pretty good, right? So over the past few weeks, over the past few months, I've thought a lot about my philosophy as an investor, the kind of picks I want to choose. And I have seen zero other investors mention this. I've seen zero. When I say zero, it's zero super investors that are doing this strategy and zero people on YouTube doing this. So either I don't know where to find them or I'm starting something new, but I want to share it with you today. So you have the exclusivity. The philosophy I want with my portfolio going forward, and over the past 10 years, I have figured out this is a very good system because it's working most of the time, is you want efficiency beasts. Efficiency beasts, capital light, and companies that like their shareholders. And how it translates is you want, I want my portfolio to have a CAGR for revenue. Let me put this, revenue CAGR that is at 8% per year. That would be a good metric. You want the revenue CAGR to be below the EBIT CAGR. So I don't know, let's put 10%. Now it means your CAGR is your compound annual growth rate. Over the past 10 years, 20 years, 30 years, I want the business to grow revenue. So first of all, growing businesses, which means you want to discard the stable businesses, the declining businesses, the turnaround plays, the value traps. No. My ideal portfolio is filled with quality companies that will outperform the market. And the formula I am about to show you is the reason why I am making 25% per year. Because my best investments had these characteristics. Okay, so I want the revenue CAGR, let's say 8%, but you can twist some numbers, to be inferior to the EBIT CAGR. Okay, EBIT is operating income, which means the difference between these two elements are more margins, better gross margins, better operating margins. And I want this EBIT CAGR, the growth rate for the EBIT, to be inferior to the net income CAGR. Net income, I don't know, let's put 12, but any numbers would do the work actually. The difference here is tax treatment, a little bit of interest. And I want the net income CAGR to be below the earnings per share CAGR. The difference here are the buybacks. The difference between the profits, the earnings, and the earnings per share, that's the per share, right? So the difference is how many shares are you buying back every year. By definition, I will invest in cannibals, Uber cannibals, companies that are buying themselves, companies that are eating themselves up. They are buying their own shares. They are investing in themselves. So the earnings per share should be 15%. Okay, fair enough. Now you can twist some numbers. You can start not with 8%, but you can start your revenue growth rate of 10%, which means an EBIT growth rate of, 13%, a net income CAGR of 16%, and an earnings per share of, 19%, 18%, 19%. This is a good framework. And if you can only invest in these golden opportunities, I believe you increase your chances of outperforming the market. Based on this, what are the good candidates? Regardless of valuation, if I had to create a dream portfolio, because now this is a principle, but what are the companies that fit this criteria? The first company that comes in mind is FICO. That would be the top one investment here. Because additionally, I mean, they fit this. The revenue, CAGR, they fit this framework very well. You can check at home. But at the same time, you want companies that are asset light. So efficiency. So perfect for inflation, which means almost no capex. FICO has almost zero capex. FICO is Fair Isaac. This is a company that creates the FICO scores in the US. And over the past few years, the growth has accelerated. And now for their score segment, so they are doing scores, the EBIT margins are at 87%. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. It's very likely that this trend continues in future years. So FICO is very likely to grow their revenue at 10% per year, but it's all about margin improvement. So more earnings per share, and all the cash flows are going towards buybacks. So the way FICO allocate capital is very simple. They don't want to make acquisitions. They don't want to dilute shareholders. They don't want to issue dividends. They had a small dividend in the past and they completely stopped the dividend policy in 2017. They said it was not tax efficient, which is a very smart way to think, like Warren Buffett. And they allocated 100% of their free cash flow towards buybacks. So the earnings per share growth has been 20-25% per year. This is good. I was a shareholder of FICO in the past, and the stock went up immensely. I sold at a profit because the valuation became just too expensive, and I want to buy back in. Now the valuation is still too high. I bought FICO back in the days in late 2021. I remember I wrote a Seeking Alpha article back in the days, 4 years ago. And I don't know if it's public anymore. Anyway, and I had some very nice profits. Valuation went up. People realized it was an extremely well-run business model. So FICO is a good candidate for my ideal portfolio. Next candidates you have are Fortinet. If you think the cybersecurity industry will thrive in the future, you have a few candidates. You can invest in Palo Alto Networks, CrowdStrike, Zscaler, Checkpoint, or Fortinet. Fortinet, out of all the cybersecurity providers, Fortinet is profitable. Profitable is the only one that loves their shareholders, because this is the only company in the cybersecurity industry that is doing some buybacks. So let me add some notes here. FICO, here you have Monopoly, earnings per share growing 25% per year. For Fortinet, you have a growing industry. The cybersecurity industry is expected to grow at 12-13% per year. And with AI, the cybersecurity industry will accelerate. So you are positioned for a very, very good wave. You have a very good tailwind. Only cyber company that loves their shareholders, because this is the only company that is thinking about a per share metric, buybacks. They just did their biggest buyback ever. So you don't have any other cybersecurity company doing this. I'm aware you have another company called Checkpoint, but Checkpoint is not growing. So the difference is, yes, they are both doing buybacks, but Checkpoint is not growing. So it's like a dying business. And as I told you previously, you want this kind of efficiency. Checkpoint is not growing the revenue at 10% per year. So Checkpoint is out. Fortinet has been growing their revenue at 15-20% per year. Fortinet is improving their margins. Fortinet is doing buybacks. That fits the framework. Okay. Another example I have in mind is MSCI. MSCI, you have a clear leader in their industry. And they love their shareholders. They just announced a massive buybacks for MSCI. They do leveraged buybacks like FICO, and they are very asset light. Extremely asset light, I would say. Extremely asset light. And yeah, the capital allocation decisions for MSCI and Fortinet are the same as for FICO. They don't want stupid acquisitions. They don't want stupid dividends. They don't want diversification of their business model. They have one niche, one product, one service. They focus on their niche. They innovate in their niche. Then reinvest a little bit to still be the leader in their category. And they do what they do best, which is why they become efficiency beasts. Efficiency beasts. You are talking about businesses that are not doing stupid acquisitions just to diversify and tap into another area. Another competitor, if you look at MSCI, is S&P Global. S&P Global is diversifying away from its ratings agency, from its index segment. MSCI is not diversifying. MSCI is focusing on a niche market, and they are becoming more efficient. End of the business model. And if you focus on a niche market, you stay on your lane, in your lane, you reduce the risk. Because if you diversify away from your core operations, this is risky. What if you make an acquisition and this is a bad acquisition? The synergies are not here. So pretty interesting. How can I make a video about my ideal portfolio without mentioning TPL? I'm mentioning TPL, but I can also mention Landbridge. These are two companies that fit all my criteria, clear framework. You are talking about, I would say, monopoly. I mean, you don't have any competitors in their niche because these are two companies that own lands in Texas, Texas Pacific Land and Landbridge. TPL has been my best investment ever because I bought the stock back in the days in 2020 and I sold at the absolute top in November 2024. So look at the 10-year chart. I bought when nobody wanted to touch TPL. I multiplied my wealth by 8 and I sold at the absolute top in November 2024. And now the valuation is still too high, but I want to buy again. If the stock drops to a reasonable valuation, I will buy again. It's an absolute gem of a business, and I know the business quite well. The management is not so great, but it's okay because the quality of the business model. So Monopoly, perfect inflation hedge. If inflation is hot in future years, TPL and Landbridge, they have no cost. They have no capex, zero capex. They don't have any threats. They don't have any employees. So if there is inflation, it will just generate more revenues for them. So they can just enjoy royalty streams. These are two royalty companies, and I would love to hold both in my dream portfolio. So efficiency beasts, sky high margins, and they are just rewarding shareholders. In the past, TPL did some buybacks. Now TPL is no longer doing buybacks, so it doesn't fit this criteria. But the quality of the business model is so good, the monopolistic position is so good that I am including it in my ideal portfolio. I would say this is a pretty good list of high quality companies. You have other candidates also that have good potential of outperforming the market. You have Visa and Mastercard, so it's a duopoly, asset light, buybacks. You have a lot of buybacks, a lot of resiliency in this portfolio. So Visa and Mastercard are two businesses that are clear leaders. You only have two players in the world, more volumes, more transactions, more cards. As the world is improving, you are operating like a toll gate. So Visa and Mastercard, I see them as royalty companies. As the world is improving, Visa and Mastercard are improving, and they take a small fee out of the world improving. They are built Their network is built on the whole world, excluding China. Everybody is using them. You have no disruption risk. I am aware that every couple of years you have some headlines of new disruption risks. Now it's stablecoins. If you are worried about stablecoins, you can refer to all the other worries we saw in the past. Every couple of years you have a new risk that rises, and then Visa and Mastercard are integrating this new disruption risk into their business, and Visa and Mastercard are safe. So Visa and Mastercard are growing their revenue nicely, 11, 12% per year, growing their margins nicely, growing the buybacks nicely. So they are growing their earnings per share at 18, 19, 20% per year. Extremely well-run business model. Let me put some other potential candidates. My biggest position right now is Brookfield. Is extremely well run, but for the ideal portfolio, if I had the choice disregarding the valuation, I would choose FICO better than Brookfield, right? You have AutoZone. If I had the choice, I could include this one because it's such a resilient business model. AutoZone or O'Reilly, same thing regardless of valuation. But I think in terms of growth, Fortinet, TPL, they are better. You have obviously Meta, you have Google, but now they are increasing the CapEx spending. So in terms of longevity of returns, in terms of, I could include Amazon also. In terms of longevity of returns, buybacks, margins, they don't fit this ideal framework. So if I had the choice disregarding the valuation, I would not include these three. I would include other businesses. Another stock that I have right now is Lam Research. Lam Research fits this framework, but if I have the choice, investing in AI, either you can invest in chips or chip companies, or you can invest in AI-related industries like HVAC, for example, or energy companies like Vistra or Constellation Energy, these kind of things. If I had the choice, with my circle of competence, and the visibility I want for my portfolio, Lam Research would be a little bit too cyclical for my taste. So again, if I had the choice, now you have to account for the real world and the valuations. Lam Research has a certain PE ratio, around 30. FICO has a PE ratio around 60. So yeah, in a perfect world, I would choose FICO. But now I think FICO is too expensive for my taste, right? For other investors, I understand what they are buying, but it is my ideal portfolio. So yeah, you have a couple of candidates here, but if I had the choice, given reasonable valuations, this would be my ideal portfolio with this ideal framework. And I'm very sure that with this portfolio, if you can buy them at a good price, with the good stock picks, at a good price, at a good valuation, you increase your chances of outperforming the market by a lot. Because these businesses are very efficient. They love the shareholders. You have no major risks. You have many tailwinds happening at the same time. They will grow their earnings at 20% per year. And in the very long term, stock prices will follow earnings per share. So if your earnings per share are growing at 20% per year for 5 years, 10 years, your stock price will grow at 20% per year. This is the reason I'm making 25% per year, because I can spot these opportunities where earnings per share can grow at 20% per year, 25% per year. This is the reason I can outperform the market. And you see, I did not talk about value plays, turnaround plays, dividend plays. No. You just focus on leaders, companies that love their shareholders, companies that are asset light, efficient, especially in the world with inflation. If you think inflation is here to stay, you don't want companies with a lot of costs. You want royalty companies that will just ride the wave of inflation. In case you have inflation, they will benefit immensely because they don't have any costs. And in case you don't have inflation, they're fine because the business model is excellent, efficient, right? So you win. In every scenario, you win. And also, this is another reason why you can outperform the market. Another way you can outperform the market is to focus on companies when either way you win. Visa and Mastercard are very good examples. If you look at the latest recession, 2022, all the stocks went down, the consumer sentiment was down, the oil prices went up. It was a mess, messy world. Visa and Mastercard continued to increase earnings, increase revenue, increase buybacks. They were not impacted at all by what happened to the world, all the conflicts of the world, because the business model is so good, so resilient. Nothing can really disrupt Visa and Mastercard at the moment. Maybe in the future we will see, but so far I see no risk. So yeah, this was my ideal portfolio if I had the choice to start from scratch, disregarding the valuation. I hope it was helpful to you to really understand the framework and how you can also outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.